It starts with a paradox. A country strikes oil and decides not to use the money. Not really, not in the way you'd expect. While most nations treat oil like a lottery ticket, spend fast, build big, promise everything, Norway did something almost uncomfortable. It said no. No to easy wealth. No to sudden spending. No to acting rich, even when it became one of the richest countries on Earth. And that decision might be the reason it's still rich today. Because oil doesn't just make countries wealthy, it ruins them. In the late 1960s, Norway wasn't special. It was stable, calm, relatively modest. Fishing, shipping, a small industrial base. Then, in 1969, everything changed. Oil was discovered in the North Sea, and not just a little, massive reserves, the kind that transforms economies overnight. Now, historically, this is the moment where things go wrong. Governments panic with excitement. They increase spending. They cut taxes. They promise citizens a better life immediately. It feels justified because the money is there. But that's exactly the problem, because oil wealth doesn't behave like normal income. It's temporary, it's volatile, and it comes without effort, which makes it incredibly dangerous. There's a term economists use, the resource curse. Countries rich in natural resources often end up poorer, more corrupt, and less stable than countries without them. It sounds backwards, but it happens again and again. Sudden wealth distorts everything. Currencies strengthen too fast. Other industries collapse. Governments become dependent on one revenue stream. And politics turns into a fight over who gets the money. You don't build a strong economy. You inherit a fragile one. And Norway was watching all of this happen in real time. By the 1970s and 80s, other oil-rich countries were already showing the pattern. Boom, spend, collapse. Norway had a choice, follow the same path, or do something that at the time looked almost irrational. Delay gratification. So instead of flooding their economy with oil money, they created a system designed to resist temptation, not eliminate it, just control it. In 1990, Norway set up what would later become the largest sovereign wealth fund in the world. Today, it's officially called the Government Pension Fund Global, but its logic is simple. Take the oil money, don't spend it, invest it globally. Stocks, bonds, real estate, across thousands of companies in dozens of countries. Instead of injecting oil cash directly into the Norwegian economy, they export the money and import returns. It's a quiet strategy, but extremely powerful, because it separates earning from spending. Here's the key rule. The government is only allowed to spend a small percentage of the fund each year, roughly around 3%. Not the total wealth, just the expected long-term return. So if the fund grows, spending increases slowly. If markets fall, spending tightens automatically. This does something unusual. It makes a rich country behave cautiously, almost like it's not rich at all. And that's where the paradox deepens. Norway is sitting on over $1 trillion in assets, one of the largest investment portfolios on Earth. Yet it doesn't spend like $1 trillion country. No extreme tax cuts, no massive unsustainable subsidies, no sudden economic overheating, because the system doesn't allow it. Even if politicians want to, this creates a strange kind of discipline, the kind most governments struggle to maintain. Because politically, saving money is unpopular. Spending money wins elections, especially when that money feels free. But Norway engineered a structure where breaking the rules is visible, costly, and culturally discouraged. Over time, this became more than policy. It became identity. But here's the uncomfortable part. Norway isn't just being responsible, it's also being strategic, because spending oil money domestically would create a hidden problem: inflation. Not just normal inflation, structural inflation. When too much money floods a small economy, prices rise faster than productivity. Wages go up, costs go up, and suddenly, industries that aren't related to oil can't compete anymore. This is known as Dutch disease, and it quietly destroys diversification. Norway understood this early, so instead of letting oil distort their economy, they insulated it. They kept their domestic economy relatively normal, while their wealth accumulated somewhere else. But that leads to another contradiction. If the money is invested globally, who is actually benefiting? On paper, Norwegian citizens. In reality, the benefits are indirect. Better public services, strong social systems, long-term stability, but not explosive short-term wealth, which can feel underwhelming, especially when compared to countries that spend aggressively. Skyscrapers, mega projects, instant transformation. Norway looks restrained, almost conservative, and that restraint is deliberate because oil has a deadline. It doesn't last forever, and more importantly, the world is slowly moving away from it. Climate policy, renewable energy, technological shifts, all of these reduce the long-term value of oil reserves. So Norway isn't just saving money, it's converting oil wealth into financial wealth before oil becomes less valuable. It's turning a finite resource into an infinite stream of returns, at least in theory, and so far, it has worked. The fund owns, on average, about 1 to 2% of every listed company in the world. Think about that. Norway is quietly one of the largest shareholders on the planet, not through conquest, not through expansion, but through disciplined saving. But no system is perfect, and this one has its own tensions, because the more the fund grows, the harder it becomes to ignore. Citizens start asking questions. Why not spend more? Why not improve infrastructure faster? Why not reduce taxes further? After all, the money exists, and technically they're right. But increasing spending breaks the rule, and breaking the rule risks the entire system, because once you start spending more than the return, you're no longer living off the interest. You're eating into the principal, and that changes everything. There's also market risk. The fund is heavily invested in global financial markets, which means its value fluctuates, sometimes dramatically. In bad years, hundreds of billions can disappear on paper, not because Norway did anything wrong, but because markets move. So the country's wealth is tied to a system it doesn't control. That's the trade-off: stability for exposure. And then there's the deeper question, one that doesn't show up in balance sheets. What does it mean for a country to be rich but not feel rich? Norway has high living standards, strong welfare, low inequality, but it doesn't project excess. It doesn't behave like a country overflowing with cash because it shows a different definition of wealth. Not visible spending, but invisible security. And that brings us back to the paradox. Norway is rich because it doesn't act rich. It found oil, then built a system to pretend it hadn't, at least when it comes to spending. And in doing so, it avoided the trap that caught so many others. But the real question isn't whether this worked. It clearly did. The question is whether it will continue to work, because the pressure to spend never disappears. It only grows as expectations rise, as populations change, as politics shifts. At some point, every system is tested, and discipline becomes optional. So here's the uncomfortable thought. If another country discovered the same level of oil wealth today, would it make the same choice? Would it save most of it? Invest globally? Limit itself to 3%? Or would it do what almost every country has done before? Spend first, fix later. Because Norway's model isn't just about oil, it's about restraint. And restraint is easy to admire, but extremely hard to replicate.